Great. So thank you everybody for bearing with me now. It sounds like the sound is fine, which is always good. Right, let's get started on some charts. So I'm going to start by looking at the yen. Obviously, there's a huge amount going on in the background, so a huge amount of fundamentals going on. Those of you who've joined me before will know that. They will certainly have heard that from me before anyway, and I'm sure you'll sick to death of reading it. But there's really interesting stuff going on in the price action as well, and primarily that's in the yen. So let's take a look. The chart that you can see here is dollar yen, so it's the daily chart. I just wanted to show you to say that it had broken above some key levels. Obviously, it was almost a triple top, and it broke through it. So that kind of coincided. That was about the 78.30 level. It coincided with the 200-day moving average that came in about 78.05, and it still looks good. The chart patterns look nice. It's got a nice upward. A very nice kind of upward slanting trend there, and looks like kind of 76.20 was the low that we put in. Now I also want to show you something else. I'm not sure if you can see this chart. I might just turn the camera off and turn it on again just to double check, because this is a different charting package I'm using today. But this chart is another really interesting one. It's sterling yen. I bring that out because it just broached or got through, or testing, you may point out, a really key level. So again, it's done very, very well since kind of the middle of, or made a low in kind of late January. Since then, it was a bit choppy, but it was moving higher, and it has been propelled by kind of the news that we've heard out of Japan this week, that they were going to expand their stimulus program to the tune of like an extra 10 billion yen. So it's enormous. But basically, the Bank of Japan has decided to kind of flood the economy with yen. They have also pledged to make an inflation target, which means that more stimulus is likely. And what does that tend to mean for somewhere like Japan, for somewhere like the US? QE essentially is what they're doing. When that happens, it means a weaker currency, and that's what we're seeing now. So as you can see, it's all the yen crosses. We've just seen dollar yen. It's the same in sterling yen. Really importantly, though, 123.30. That was a really key level. That was a 61.8% retracement level of the just the late August high to the mid-October low. So we've seen that retracement there. Now that we've gone above there, that really opens the way to kind of the 124.30 area, which is the 200-day moving average, and then above there's kind of just below 125. And then obviously even higher, potentially if we can break above kind of 124 at some point today. We're currently around 123.45-ish. If we were to break above that 124 level, then potentially we could kind of target 124.30, that 200-day moving average, which would be again just another sign that another confirmation really that dollar yen has turned. However, we would, right now the momentum is very much on the side of dollar yen. Now, I'm going to bring up my other charts as well so you can see the oscillators. Let me just turn off my chart 1 second. So here you go. This is actually the same chart. It's just a different charting tool. Different charting package. And this is dollar yen. So as you can see here, this is the 200-day moving average I pointed out. Comes in at kind of 124.30-ish. This is the daily chart. So this is the daily oscillator. So this is the daily RSI. Pointing higher. Now it is close to getting to its peak. Let me just draw that line here. So we're not that far away from your traditional overbought territory. So it could slow down as it gets to that 124.30 level. As potentially traders take profit and the like. Let's take a look at the hourly. Again, the hourly is losing a little bit of steam around the 123.30, 123.50 level. So that would be completely normal, especially because we've just got above that really important Fibonacci level at 123.30. So we would expect a bit of a pullback. That would be very normal. How far would we expect to pull back? Well, as I said, 123.30, since we got above that, that's now acting as support. Or since we got above that resistance is now support. And then on the other hand, we'd also look at the 21-hour moving average, which is just above 123, so about 123.05. So we believe that if this yen reversal has got legs in it, then we would expect only shallow dips. Now, the one thing I would point out, I think in the short to short to near term, the yen looked weak. I think it could weaken further. I think we could potentially see. I'll bring up dollar yen as well, just so that we can look at that, because obviously that is one of the world's most traded crosses. So what goes on in dollar yen is going to have a massive impact on what happens in euro yen, what happens in pound yen, and everything else. So do remember that kind of the fractal way that markets work. So one thing that I would point out in dollar yen on the hourly, obviously it has kind of pulled back. It did break above that 78.50, got to about 78.62. 78.66 was the high today so far. It's since pulled back, but it's finding good support here at about 78.40. So the range is actually fairly narrow. So the low today's been 78.36 and the high 78.66. So whereas in the near to medium term, we believe that dollar yen could potentially strengthen further. Let's take a look at the daily, just to see where we think that could go. Obviously, kind of it broke above the 78.30 level. That's now good support if it was to pull back further. That's held as support so far today. And then above here, you've got to target 79, even kind of 79.20 level. Obviously, on the daily, again, we would point out that usually with the RSI, remember, because it's starting to move towards the overbought territory. However, dollar yen has traded in such a tight range for such a long time that it could easily start to look oversold, whereas it's actually just kind of breaking out its range at just new epoch. But the one thing that I would point out, I'm going to show you a different chart now, so sorry for jumping around with all the charts, but I hope you find them interesting. I certainly do. This is more of a kind of a fundamental way of looking at dollar yen. Just bear with me while I pull up the chart. For those of you who follow us on Twitter, please do. We're at Forex Research. That's us on Twitter, or forex.com as well. So those of us who follow us on Twitter will have noticed that I actually posted this yesterday. So this chart shows the white line is the 10-year Treasury yield, and the orange line is dollar yen. And really, they tend to have an incredibly close relationship with each other. And what we've seen, obviously here, we've seen some divergence. We've seen dollar yen, which is the orange line, shoot higher, while we've seen the 10-year Treasury yield come lower. Now, there aren't many times at all when this pair hasn't been moving in the same direction. So divergence in this pair is very, very rare indeed. Now, obviously, some of this reason for this kind of decline in the 10-year is due to kind of safe haven flow coming out due to Treasury, coming out due to what's going on in Greece and what's going on with the Eurozone. And obviously that doesn't have anything to do with or it does have something to do with, I suppose. It is one of the reasons why the Bank of Japan is implementing stimulus. But essentially, because the Bank of Japan is implementing stimulus, rather than kind of intervening in the FX market like they've done in the past, they basically, by implementing an inflation target, said that they will. They've gone one step further than the Federal Reserve, really. What they've said is that they will, they will throw as much money as it takes to try and bring inflation to 1%. Now, inflation in Japan is minus 0.2%. So it's got a long, long way to go before it reaches that target, which suggests plenty more stimulus. And the market is taking that seriously. And that is the reason why we're seeing the yen move higher. Now, obviously, one of the reasons why they're putting stimulus in there is because of Europe and the crisis in Europe and the threat to growth. And that's also another reason why we're getting inflows into the S&P. So, the drivers are the same, but the relationship is broken down because in the past, the Fed, I guess, has been more successful with its QE program than the Bank of Japan. But the Bank of Japan has learned and has actually implemented an implicit inflation targets for the Federal Reserve, and that's why we're seeing one of the reasons why we're seeing this break higher in dollar yen here this week. So that really has been the big mover. That's been kind of the most interesting pair out there. That's been where kind of the bulk of the movement has been, whereas what we've seen is Treasury yields fall lower. However, whether or not that comes back, I know some people do doubt for how long the dollar will be able to maintain its upward bias, purely because there is the expectation of more QE from the Federal Reserve. However, they certainly haven't taken it off the table. They still sound fairly dovish. Obviously, we've got minutes coming out of the Federal Reserve today. They'll be important to tell us whether or not, or to give us an indication really of how close more QE is. So do watch out for that. There is a risk event for the dollar yen in the distance, and also in the not too distant future. So do watch out for that, because traditionally this doesn't happen, even though there's good fundamental basis for why dollar yen is diverging away from Treasury yields. They tend to move together, and this cross more than most. So do watch out for that, as a pullback could be quite sharp and severe. So someone's just asked, is the yen weaker? Yes, the yen is weaker. So the yen is much weaker this week, over the last kind of 24 hours. So the dollar has broken out of its recent range versus the yen. So the dollar is getting stronger versus the yen. That's why it's moving higher. Okay, let's take another quick look at something else. Let's take a look at pound. Just bear with me one moment. I'll just get out of this chart. Now, we saw risk sell off quite heavily yesterday. Firstly, there was kind of overall kind of negative sentiment because it looked like Greece was going to get bailout. There'd been some weaker data as well from the UK. From the US. That was in the retail sales department. However, obviously what we said in the past is that the pound, so sterling versus dollar, can cause has got a very strong relationship with risk, with overall risk. So when the S&P and other stock markets came off, the pound tends to fall off quite sharply as well. However, one thing that we would point out, it has found some really good support here. Let's just take a look at that. So that's it. Kind of moving average support there at around just below kind of the 156, like 80 to 90 zone. That's been where we've seen some very good support. And right now, the pound has actually been trading in an incredibly tight range, between kind of 157 and 157 and 157.20. So obviously there's a lot of event risk coming up for the UK today. We've got jobless data. We've also got the inflation report from the Bank of England. The one thing that we think that they will retain their dovish bias. Now, yesterday obviously we saw inflation fall quite sharply. Traditionally that would cause the pound to fall, because it makes QE more likely. However, the one thing that we would say as well is that the pound has had a fairly good relationship with risk. So it tends to rally more on overall kind of risk appetite, so market appetite for risk or overall market risk, certainly compared to what's gone on in than what the Bank of England says or anybody like that. Now let's just take a look as well at Euro pound, because that's where you can sometimes see the divergence or the central bank divergence. So as you can see, very much kind of stuck in a range really. It's not doing too much. It has picked up a little bit, and as you can see, that's being confirmed by the slight move higher in the RSI. So as you can see, they're moving in the same direction. So kind of peaks have been the same. So it's pretty choppy. Really above here now, we'd probably test the most recent highs at kind of the 83.40 zone. Oh, one moment. before we'd potentially target 83.95. So those highs from earlier this month, that's certainly kind of worth watching, especially today with the Bank of England report. Now, the one thing that could, I guess, limit euro strength is the fact that we've also got the ECB coming out at the end of this month offering more LTRO auctions. However, the one thing that we would argue is that the expansion of the ECB's balance sheet doesn't necessarily mean that the euro will fall, purely because it's there to reduce credit risk. And when you reduce credit risk, especially in a sovereign debt crisis, that should be currency positive. Likewise with, and that's why potentially a very dovish report, inflation report today from the Bank of England, could see euro sterling outperform. So currently it's testing its 100-hour moving average, kind of above this kind of 83.75-ish level. We then get to kind of 83.85, and then above there to kind of 83.95, and obviously to 84 highs, which have been kind of the high. Turn back here. That has the 84 level has been a really hard level to break, and if we were to get above there, that would open the way all the way to 85. So we are very, very close to a key level, but 84 has proven to be much too strong resistance for euro sterling recently. So we'll have to see how dovish the Bank of England is before we could kind of push that higher. Now, someone's asked my views on the Aussie. Let's just take a look. Now, the Aussie got kind of, again, it's just reinforced its position as one of the riskiest pairs in FX. Been incredibly choppy, has been sold off kind of with overall risk. However, after dipping to kind of a low below 106.50 really, at kind of 106.30. Oh, let me just check that. So 106.31 yesterday. It's since kind of bounced back, and the reason why it's bounced back is because news out of China that happened during the Aussie session or during the Asia session that China would invest in eurozone debt. If there's one person or one country with the means and the ability to support the eurozone and to free it from where it is right now, that is Chinese. So that move higher there is on the back of the Chinese announcement. As you can see, it's had a really, really nice move. It's obviously just getting stuck there at 107.50, which also is the 200-hour moving average. But above there, it kind of opens us to the most recent highs there at kind of 107.75-ish, 107.50, 107.75. So just ahead of 108. So potentially, if we look at the RSI on the hourly, still looks really nice. It's not really into overbought territory at the moment. So there could be further to go. However, 107.50 is kind of holding it back. So remember, we have already had quite a big move overnight in risk, in the kind of the risky assets. So certainly in risky FX, because that was trading all night. We may see a little bit of a pullback today. Obviously we get the kind of the more hard news out of Europe. We've already had German finance ministers and the like on the wires this morning, again dismissing the fact that Greece will be almost kind of playing down expectations that Greece will get its next tranche of bailout funds, almost preparing the market for some sort of default by saying that Greece hasn't met all its conditions, and obviously if they haven't met all those fiscal and austerity conditions, they don't get their money. And what does that mean? Well, time is running out because it takes about 6 weeks to implement all the paperwork to release the next tranche of bailout funds. And that's why we need the agreement now, to make sure that all the paperwork is signed and sealed before we actually get before the March 20th bond redemption deadline. So time really is running out. I think Monday now is kind of the last day that they can hope to get that stuff all done. So as we get close to that deadline, obviously today Then as we get from kind of the Asia session, whereby we heard from China, risk rallied almost blind. On the other hand, what we get in the European session is a bit more of a cautious approach. That would be very normal because the risk has rallied quite strongly. Obviously, stocks are making up for it now in Europe. They're taking the lead from Asia, which is really unusual. Those of you who trade at the Asia session or cross over Asia with Europe, usually Asia is not doing too much. It will move on the back of what the US and Europe has done the day before, if you like. Well, not the case. Obviously, this shows just how important China is. China came out and said that today, and it caused a huge upswing in risk. But as I said, just this congestion zone here, we are getting to a very pivotal level. We're about 40 pips away from the most recent high that we've seen. So that we saw we've seen kind of in the short term, and then obviously 108. We did kind of get to try and test 108.50, which had been one of the highest levels. Let's go back to the daily chart here, actually, just show how high we are. 108.50 was the high from last week. That was one of the highest levels from kind of August 2011. So we are kind of at a very overstretched level. So any dip in sentiment, the Aussie is really, really sensitive to it. We would say that there's obviously really key support now at 106.40. And that's the 21-day moving average. That is really, really important. I just want to also show you some precious metals as well. So just bear with me. I'm going to have to bring them up here. Actually, I want to show you this chart as well. It does look confusing, but it's not really at all. This is Portuguese bond yields, Italian bond yields, and Spanish bond yields. This is the purple line is German ones, and the white line is US ones. They've been normalized to show how they move together. And really what I'm just showing with this today is that, as you can see, the peripheral bond yields have been falling really, really sharply. They've been falling at the same time as the safe haven of the dollar and of the treasury yields and the German Bund. Quite unusual. Usually they move in opposite directions to each other. So it has been quite interesting to see them. So as you can see here, that's why you can see them, why they tend to diverge. Now that they're moving together, it's kind of really interesting. It's been very interesting about how the Italian or the wider periphery in Europe has been fairly well supported even during this Eurozone crisis. Now, I think of the bond market as being like kind of the big beast, if you like. Sentiment there really can seep into sentiment elsewhere. So the fact that we've had good sentiment in the bond markets and that really Italian and Portuguese bond yields haven't been that affected by what's going on in Greece is a really positive sign in my mind, and suggests to us that if there is an issue with Greece, yes, it could cause a knee-jerk reaction, but it doesn't necessarily mean that, Greece has gone to hell in a handbasket, which I think is really kind of important and worth pointing out, that the market might, Schäuble, the German finance minister, said it yesterday. Well, he might be right. He might be onto something here, that the US, that, what goes on in Germany, what goes on in Greece, the markets may have become a bit immune to it. So I do think there is something there. You don't often see Portuguese bond yields and US Treasury yields moving in the same direction, but there you go. Does that mean that there's less risk in the Eurozone overall? It may do. We'll have to wait and see. But that's just something to point out. Now, another thing. So basically what I'm saying is that yes, things could be choppy going forward, but when you've got an environment whereby central banks are pumping liquidity into the market, usually once the dust settles from this Greece thing, once it gets to some certainty, either they default, and that's, and that's the certainty, and it's figured out, and there's an orderly default, or they don't. Then what we see is, what we end up seeing is kind of markets will want to rally. They just, they're just prone to bouts of. They're obviously prone to negative headlines. Now, someone's just asked, can Italian? I think it means if Italian yields, will US yields rise if peripheral yields fall? I think that's what the question is. I'm not. I mean, I think they could, but I don't think to a huge extent. The reason why is because yes, obviously, if you've got China going in saying that they're going to support Europe, they're going to buy European bonds, then that suggests that they won't be buying as many US bonds. China is the biggest foreign holder of US bonds, so that could be problematic. However, I think that bond yields in the US are really they're going to be capped on the upside because the other side of who's buying this is the Fed. They're a huge purchaser of treasuries, or have been anyway, and they've pledged to keep interest rates really low. So that could cap any rises in US bond yields. But we do think that the China news, along with kind of what the ECB is doing in the LTRO auction, should really keep pressure off peripheral bond yields. Now, someone asked another question, should Greece leave the euro? Well, I guess for us as kind of retail traders in the market, it doesn't really matter if Greece stays or goes. But I think there's definitely a consensus now that the Eurozone could survive if Greece goes, and it's not such a taboo topic. This time a year ago, if someone had come out and said that Greece may default and leave the European Union in 6 weeks, then euro dollar would have dropped 300 points to be below 130. Well, it's not today. Yes, it's had a sell-off. It was at above 132 yesterday. It then kind of dipped below 131, but it really didn't like it. Didn't like it below 131, and has clawed back. And has really clawed back some gains. It's now at kind of 131.60. The high of today's been 131.90. But as I said, today we would expect a bit of kind of, as we wait to hear the outcome of kind of key European events, obviously that Eurozone finance ministers conference call and the like, it's going to be really kind of important to, there is a lot of headline risk out there, and that could keep the bulls, just out of the market a little bit longer. But in terms of, should they, well, there's plenty of arguments on both sides for them to go, for them to stay, but it doesn't necessarily look like if they go that, everything else in the market is going to be, is going to get ruined, if you like, or risk appetite is going to get slammed. Not necessarily. There would definitely be a knee-jerk reaction, but if they could organise some sort of orderly default, that would be the best outcome for the market, I believe, at this stage. Okay, if there's no more questions, my time is pretty much up. So thank you all for joining. It was really interesting discussion. You guys asked some really good questions. So please do join us again. And as I said, do check us on, one last question. Someone said Euro Swissy in a very tight range, but FX can never be in a small range for too long. Which way will it break? Well, Euro Swissy, interestingly enough, has been in a range, for such a long time, that it can, stay, or it has proven that it could stay in a range for a long time. The one thing that I would point out is that you've obviously got the reason why isn't because it's normal market action, it's because it's being controlled by the Swiss National Bank. So that's one of the main reasons. 120, as we've said before, is the real, it's the line in the sand for them, for the SNB. So as we get closer to 120, for example, if we were to drop below 120.50, which we haven't done for a while, then we could see some real upward pressure on Euro Swissy, largely because that's when the SNB could step in. So do watch out for that. Again, thank you everybody for joining. Please do remember that, yes, they can look like fantastic opportunities when we see such low volatility in a currency like Euro, or a pair cross like Euro Swissy. But what it can mean is actually that there's something else going on, and for the example of Euro Swissy, it's obviously the S&P action. So I hope that's useful. Thanks very much, and hopefully you guys can all join me on Friday. Okay, bye-bye everybody.